You are listening to The Investor Way with Sam Ball and Jonathan McEwen. If you enjoy the show, please subscribe and follow us on Twitter at TIW Tweets.
Hello, welcome to The Investor Way with me, Sam Ball. It's the 13th of July, 2023, and I'm joined today by our special guest, Andy, who goes by his Twitter handle, Flying Finance. So, Andy, firstly, thank you very much for coming on the show. Do you want to just tell us how you first became interested in investing and just to briefly talk us through your investing career to date?
Yeah, absolutely. So originally, many years ago, I studied a degree in business management. So that really piqued my interest in investing, business and finance and the like. When I finished that degree, I went on and did a postgrad in quantity surveying and worked in the construction industry for about 10 years or so. Did a mixture of commercial, residential, and quite a lot of renewable energy towards the end of my career there. In terms of investing, I started probably about a year after I graduated, so that was about 2006-ish, like a lot of people, just having a spare few £100 each month and looking for sensible places to put it. So my first company I bought was just off a tip in the Investors Chronicle, really. I didn't know what I was doing, but it seemed like a good place to start. It's a company back then called Next 15 Communications. I think they just changed the Next 15 group about a month ago. And really, it just sat there and it did nothing. It kind of sat and made me about 3 or 4% a year. Back around that time, it was in the good old days when you could get on a regular investment, like a regular savings account, you could be getting 10% interest. So I kind of went down that avenue more because it just seemed much more profitable at the time. Absolutely zero risk, just running it through regular savers. Obviously, a year or two later, 2008, 2009, the credit crunch hit, and I sat and watched the FTSE dropping and dropping and dropping. When I was looking at it, it was often losing kind of 7, 8, 9% a day. I think in a year, it lost about 30%. So that really triggered my thought process. I saw an opportunity there. So I put some money into an ISA, straight into just a FTSE 100 tracker. And after the next couple of years, obviously, that recovered quite quickly. Fast forward a little bit, I decided that the construction industry wasn't really for me. So I quit that and retrained as a pilot. I've been doing that for nearly 10 years now. I took a bit of a break from the investing, mostly because I had no spare money, but also lots of other stuff going on in my life around that time. Got more interested in it again about 2016 after I finished all my training and started working. So currently I manage a stocks and shares ISA for myself, a lifetime ISA. I also manage my own SIP, and I've got some of my wife's money and a savings account for my daughter that I manage. So that's kind of my background. I tend to be fairly inactive as an investor. I tend to buy shares with a view to holding them long term, by which I mean ideally 10 years plus, but certainly no less than 6 months or so. Very, very little I sell within 5 years or so. I've got a portfolio, probably about 30 shares, mix of ETFs, a few funds. I'm quite into my REITs, real estate investment trusts at the minute, because there's a bit of a pullback in the price. That's kind of my path to date.
So how did you end up reading the Investors Chronicle then in your first year out of university?
I think it was more the fact that when you go to WH Smith's or wherever, that was pretty much the only publication on the shelves, really. You know, you could get the Financial Times, but that was more about macro stuff maybe, or news rather than at a company level. I think I just kind of flicked through the IC a couple of times and really enjoyed reading it. It's a very, very well-written publication. I had a subscription to it right up until about a year or so ago. I just don't have the time to read it anymore, unfortunately, but they have a really good podcast that I highly recommend if anyone out there hasn't listened to it yet, where they cover a lot of the bigger stories. But yeah, that was how I found it, really.
So when you retrained as the pilot and you took the break, what happened to your portfolio? Did you leave it as it was, or did you liquidate it?
Yeah, there were a few bits I had. Tesco's is one that I recall. Next 15 I still hold to this day, 17 or so years later. So some of the longer term stuff I kept on to, but a lot of the ETFs and funds I had around that point, I dipped out of, just because I knew I wouldn't be putting much effort into managing them for the next 3 or 4 years. And obviously I was taking out a large loan to cover my training, so it seemed to make more sense using those funds to pay for some of the training rather than sitting doing very little, really.
What happened to you? So you mentioned you've got a SIP now. What happened with your pensions throughout your career, if that makes sense?
Yeah, so I had a decent-ish pension from my construction industry days. That just kind of kept chugging away in the background. And then obviously working in aviation during COVID, I had a lot of time on my hands. So I was very lucky that I kind of sat back for a week or so, consolidated all my pensions, all my savings accounts, brought them all together into a AJ Bell SIP. just to keep it simple, I ended up having pensions of about 5 or 6 different companies, and it was just a nightmare trying to keep track on them. So just consolidating all together and trying to get them into one place. All my construction pensions are now into that SIPP as well now.
Is there any particular reason you chose AJ Bell?
I was really impressed with their customer services early on. There were a few queries I had, and I kind of phoned them expecting to be put through to a big call center and wait on hold for ages. And I literally phoned them and they picked up the phone instantly, and it was a human being there, and they spoke to me and they sorted the problems out in like 2 minutes flat. And to be fair, I've probably been with them now for about 6 years or so, and I just can't fault their customer service at all. Appreciate they're slightly more expensive maybe than people like Halifax. I looked at Hargreaves back when I made the switch to AJ Bell, or a fair bit more expensive than AJ Bell. And really, I don't have a motivation to change, to be honest, because it's been brilliant.
What are the fees like at AJ Bell?
I couldn't tell you offhand. I know the transaction fees are $9.95 for a regular investment, i.e. just going onto the website and buying something. If you do a regular kind of on a calendar day investment, they do a tranche of purchases on the 10th where you can buy shares for £1.50. And I think if you hit something like 20 or maybe 30 transactions a month, your fees come down quite a bit. I just don't trade enough to make use of that really. So I make use of the regular investments on the 10th of each month to get my costs down. I trade very, very little aside that.
So obviously you followed the podcast on Twitter, and then we met at the Fundsmith AGM.
Yep.
Have you been to any other AGMs besides Fundsmith?
No, I've not. And partly that's, if I'm honest, just out of laziness, that even though I live in London, just going into London is a bit of a pain and it takes up quite a lot of time. I also feel there is a slight negative side, want a better word, for going to these things. When you meet company directors, they're always exceptional salespeople. And it's very easy to go to these shows and AGMs and listen to people presenting and be won over by their wonderful stories and promises and whatnot. I think the difference with going to see Terry Smith, you're investing in a basket of shares. He's fairly famously quite an honest, straight speaker. Even though he's obviously an exceptional salesperson, I feel like it doesn't really interfere with my independent thought process on it. Whereas when I've seen some of the Mello presentations, I don't know if you're familiar with Mello.
No, I'm not.
It's a meeting in London. They did it virtually during lockdown. It's for private investors, and they normally get about 6 or 8 companies to present either their latest finances or just a general pitch on what their company does. But they're always trying to sell you their shares, and they're very, very good at it. They wouldn't be there if they weren't. I feel like it's quite easy to get trapped into a mindset of watching someone sound very convincing about their company. So I do still watch some of these shows. I try to do it more online because it's more convenient. So Mello, some of those are online. You normally get a discount code floating around on Twitter before the event. There's a YouTube channel called Invest to Meet Company. They're pretty good with interviews with various director companies. PI World is similar, and Vox Market. I tend to get most of my stuff from there. It's also quite time efficient just to be able to scroll through stuff when there's questions that aren't really as relevant for you.
So could you talk us through your investment appraisal process and how you would approach looking at a new stock or a potential investment?
Yes, I feel like a lot of my time, certainly in the last 3 or 4 years, is more about collating a decent watch list of shares that sits there in the background, and I put a minimal amount of effort into monitoring those shares, but before they make it onto the watch list, I put quite a lot of work into making sure they're the sort of companies I would be interested in investing in. So I do read the tips. I don't use tips anymore because I find that they don't normally work for me. And generally also when people tip a share, you get a lot of low conviction buyers of the share. The first hint of bad news, those people exit the market, and you tend to get quite a downtrend on some of them. I do use them for ideas. I do use them to put on the watch list, and will quite often sit on some of those tips for 2, 3, 4 years before I feel like it's the right time for me to purchase them. So in terms of getting ideas for my watch list, I really like Shares Magazine, which is the free in-house magazine that AJ Bell produce each month. There's some articles that are less good, but got one guy, Ian Conway there, I think his name is, who writes for the FT and the Telegraph and a few other people as well. He does some really, really good articles, and they do good sector analysis. So I get some ideas from them. There's various podcasts. Obviously, your one brings a lot of shares onto my radar. Money Week, it's a fantastic magazine. It covers a lot of articles, a lot of different shares crop up in there, a lot of industry-related stuff. And then I also subscribe to Stockopedia. I really like, they have a lot of screens where you can screen based on various criteria. So they've got like a Warren Buffett type screen, a Joel Greenblatt type screen. And if you're looking for something particular that will slot into your portfolio, I find that's a really good way of kind of sorting through a lot of shares very, very quickly and maybe whittling it down to 10 or 20 that might benefit from further research. I find I'm very busy, so one thing I tend to use quite a lot is the Stockopedia ranks. For those people that don't know, Stockopedia is a website where you can get data on shares. They take that data and they give them a rank for quality, a rank for value, and a rank for momentum. So I find that's quite a quick way of discounting shares that maybe I thought were good, but if they've got a very, very low rank, either it's an area I'd probably want to do more research in before buying the shares, or have a little look at adding them onto the watch list more long term. So at the minute, I've got watch list of about 45 shares. I think generally I look at each of the shares on that for maybe 5 or 10 minutes a month, see if there's any RNSs on it. But what I'm trying to do more and more nowadays is try to use some technical indicators to work out when's a good point to enter a new position. So the one that I'm quite keen on at the minute is a 200-day moving average. I like to see that trending upwards. I also like to buy as the share goes through that going upwards. There's a lot of shares I've bought over the years where I thought I was getting an absolute bargain because they pulled back. And then, you look back a year later and they've halved again and they're still sat in your portfolio doing nothing. So if I go through historically looking at the shares that I've bought, that 200-day moving average with benefit of hindsight would have been a superb tool. It would have got me into shares at better positions. And then one thing myself and a lot of people anecdotally seem less good on is exiting positions. So it just gives me a bit of a nudge as it drops back through the 200-day moving average. So maybe just have a review of the share, see is this something I still have conviction in, and go from there. One thing I really like on Stockopedia, they have this checklist function. And as a pilot, I'm really keen on checklists. There's a Charlie Munger quote about the importance of checklists of pilots, and it's something I've tried to integrate into my investing more and more. If you want me to run through it, generally I look for stuff with market cap over about 100 million. I look for earnings per shares increasing at 3% or more over 5 years. I'm not looking for high growth, but just wanting some growth there rather than shrinking company. I look for positive free cash flow. It doesn't really bother me how much there is. I look at some value stuff as well. I look for low gearing, looking for a current ratio higher than 1 just to ensure that it's not too many liabilities on the balance sheet, and also looking for shares that fall into the top 30% or so in the industry. I use an Altman Z score of higher than 3 just to try and identify any shares that might be in financial distress if I can steer clear of them. I try and weed out anything that's got high volatility. So there's a couple of metrics on Stockopedia you can use. I just find for psychological reasons I prefer shares that aren't too volatile. I try and buy stuff kind of within 2 days of the moving average, and ideally with the 50-day moving average increasing above the 200. So you can use those checklists either with a specific company in mind, or you can do it the other way and use them to screen. So I'm quite keen on that. When I have capital available and I'm in a position to start a new holding, I normally start a small position, which for me, I'd say would be maybe 0.5 to 1%. And then I'm quite keen at the minute on trying to increase my position if my conviction increases. So if I buy a share and it creeps up in value, that's normally a sign to me that my interpretation of the direction of the company is correct, and I'll try and add more money into that. That was something I was very hesitant about doing early on when I started investing. If I bought a share and it went up 10%, I think I'd missed the boat, and I've learned over the years that's definitely not the case. And even once shares do increase, you can still make good money by increasing your position in it.
How would the 200-day work then in terms of if you're looking to buy a share, where does it need to be in terms of the 200-day? And if you're looking to sell a share, where would you want it to be as well? So
there's various theories on this. My personal theory and the practice I try and do, I look for shares that are either above the 200-day moving average or they're about to pass through it. So one I've got in front of me that I'm sure we'll chat about at some point today is Supreme. So look at their share price. It's just gone above the 200-day moving average. It's currently 12% above. The 200 is about £1. So about a week and a half, 2 weeks ago, it looks like they've just gone through the 200-day moving average. So on Stockopedia, I'll then add an alert saying, as soon as they go beneath that again, that's the trigger for me to do a bit more research and see if I still want to hold it. So looking historically at Supreme's share price, it's not a fantastic example because they haven't been trading on the market that long, but they dropped below the 200-day moving average about February, March 22 at £2 a share. I think I held them around that time, so I probably should have exited it then because I could have then topped up when it went above the 200-day moving average just a couple of weeks ago. So that's my idea. The one thing that does do, if you follow it too aggressively, you obviously can incur a lot of trading fees, particularly looking at Supreme. They've probably passed through the 200-day moving average maybe 4 or 5 times this year already. So There's some theories that suggest if it's 1% below the 200-day moving average for 3 days, that's a sell signal. I think it just depends on what your own model is for trading. I like to trade very, very little, so I use it as a cue to do more research rather than an automatic sell signal. Some people will put in a stop loss at 200-day moving average and sell instantly as soon as it drops beneath it. But that's my methodology.
My next point was going to be like, how does it interact with the actual news? So, for example, with Supreme, it might be above, but because it's just come out of a crafting set of results and said it's going to beat the guidance. So obviously it should be valued higher than it was over the past 200 days because that wasn't factored into the price.
Yeah.
I think if you're using it more as like a signal to actually take a look, I guess there's some like, I don't know, you might have a different view on Supreme, but you might look at it and say, well, actually, I can discount that straight away because I know why that's above and it probably should be.
Yeah, I think it's a good point. Supreme, I think, jumped about 12% last week on the news that they had about distribution for a couple of new producers. You're never going to be able to enter that share at 8 a.m. as it starts trading because the market makers will already mark the share up by that point. If it's sat just below the 200-day moving average and then it jumps 12% on the news, you're not going to be able to take advantage of that 12% gain. So it is a little bit binary and a bit simple, like a lot of stuff in shares and trading in general. But certainly if I look at some of the worst investment decisions I've made, the 200-day moving average would have either stopped me investing in it to start with, or it'd have got me out a lot sooner. And if I look at my better trades, it would definitely have helped me a great deal with just timing, exiting it, or timing, doing a bit more research, because I don't have a lot of time to do research. So really when stuff starts to drop below a 200-day, that's a bit of a warning signal for me that I need to just do a bit more research. Of course, it doesn't really help with stuff like the COVID pullbacks either. That would have plunged through the 200-day moving average. And what do you do if it's trading 10, 20% below that moving average? It's quite a tough decision. It's not as easy as just selling the shares as they pass through it.
So how does it actually interact then with a stock where you maybe shouldn't buy it? So like, I don't know, if I think of Boohoo as an example, that's one where that probably dropped by about 2/3. And then me and John bought it and it's dropped by another 2/3. Where would, like, I know obviously you wouldn't know where that would be at the time we bought it, but if we looked at Boohoo and we said, well, actually, it's 50% below the 200-day moving average, how does that make what does that actually mean, if that makes sense? Does that mean it's cheap, or does that mean stay away because it's just falling?
It kind of means both. And some people also use the 50-day moving average if they're trying to be a little bit more aggressive, maybe with their entry and exit points. So looking at a chart for Boohoo, they were hovering around their 200-day moving average June 21 when the share price was about £3.25. They properly dropped below it about July 21 when it was down at about £2.90, something like that. So in terms of my methodology, in theory, you'd have exited around £3 a share when it went below that. And it has actually gone above the 200-day moving average around February time when it picked up a little bit. So that might have been an entry point for it. But the theory is that it would have got you out at around about £3, £3.20, and then you'd have potentially looked at re-entering it at about 50p or so when it passed back up above the 200-day.
I hadn't even got in at £3.
It was a long time ago. And the other thing with shares like Boo, they were pretty volatile. I remember seeing them drop by 10, 12, 15 cents in a day fairly regularly, and then increasing by similar volumes or similar price, I should say. So it's always tricky. The one I bought the other day was Life Sciences REIT, I think it's called, which owns Lab. That was still well below the 200-day moving average, but it's got a REIT, it's got a fair bit of asset backing to it. So I didn't feel there was much more downside risk to it. So I went in before it had gone through a 200-day. But generally, it's just something that it makes me think twice before I enter a share. Like, is it way below the 200-day moving average? What is going to trigger people buying a share and pushing the price back up?
Okay. So what are the best books you've read on investing, and how much do you read in general?
Yeah, I don't read a huge amount. We maybe touch on that later, but I certainly don't read as much as I'd like to. I'd say I probably read 3 or 4 investing books a year, which is pretty shameful, really. The ones that stand out to me as ones that are particularly good, The Psychology of Money by Morgan Housel. I feel like that should be essential reading for every kid leaving school, really. It's a fantastic book. I think a lot of people go into shares just to make money, and that's their objective, and they don't really think about over what time frame, what their approach to risk is, or anything else. So the Morgan Housel book's fantastic because it really gives some great examples of, multi-billionaires who are very, very unhappy with life, and people who don't have a lot of money who are very happy with life. And it really digs into the psychology of why you want to make money. And it's just a fantastic book. It's one of those books that you finish the first chapter and you already know you're going to be reading that book every couple of years for the rest of your life because it has so much good content. Another one I really liked, just because it seemed to strike a bit of a chord with me, The Art of Execution by Lee Freeman Shaw. So he looked at a lot of fund managers, both good and bad, and tried to identify characteristics of particularly good fund managers. And I feel up until I read that book, I was maybe a bit too passive. I wasn't really closing shares, even when they were dropping significantly, and I really had no good reason for staying in them. So The Art of Execution has a few different stereotypes of investors, and it's really good reading the book and trying to identify what traits of those you embody. And the book has a lot of statistics that maybe back up changing your approach. It's a very, very easy read. It's not technical in any way at all. So I'd highly recommend that. 100 Baggers by Crystal Meyer. I think you've mentioned that on the podcast before. That was a really, really good book. I really enjoyed reading that. A lot of simple ideas, a lot of plain English in there. Just a really thorough, interesting book. A lot of historical analysis of shares that have done very, very well and why they've done well. So I really rated that. The Phil Oakley book. Phil used to write for the Investors Chronicle back in the day. I don't know what he's up to at the minute, but he wrote a really good book called How to Pick Quality Shares. I used a lot of the metrics that he uses to identify good shares for my checklist on Stockopedia, and then I've just gradually tweaked that over time to suit what I'm doing a bit better, but it's a really good book. Excellent Investing by Mark Simpson. Don't know if you know Mark, but he runs Small Caps Live, which is a Discord channel. He quite often speaks at Mello. He contributes quite a lot of editorial content to Stockopedia. He's just a very straight talking, intelligent private investor. So Excellent Investing is a very, very good book. And then just generally, most of my reading these days is Shares Magazine, Money Week, Bloomberg Business Week, any newspapers I can get my hands on, just for a little bit more macro and global affairs, really.
How much do you read then? So you said you read 3 to 4 investing books a year. Do you read any non-investing books a year?
Not all that many, if I'm honest. No, I read quite a lot of newspapers and quite a lot of big articles from newspapers, but generally not many other books, if I'm totally honest. A few aviation-related books, but that's about it.
Do you use physical newspapers, or do you have like an app?
Yeah, so via work, I get Press Reader access free of charge. So I get all my magazines via Press Reader. Then I generally, because I'm traveling quite a lot for work, I generally carry most of my books on my iPad and read them via that, just because I can't be lugging books around, particularly some of the larger investing books. So generally, it's all electronic.
What are the best resources you use for investing? And these can be free or paid. I appreciate you've already mentioned a couple of the resources you use early on.
Yeah, Stockopedia is very good. It's about £25 a month, so I wouldn't describe it as cheap, but I think in the grand scheme of things, like if it just prevents you investing in one dodgy company, it would save that many times over. It's really good for screening stuff. It's got good articles on it. It's got quite good discussion forums on there as well. So I don't think 25 a month is too bad. That's just for the UK stocks and shares data. You have to pay extra if you want emerging markets or US or Euro. The Small Caps Live Discord channel I mentioned before, they also do a free email each week. I find Discord not the best resource for finding information. I find the layout incredibly confusing and quite frustrating. But the Small Caps Live email each Friday just looks at 6 or 8 shares, and it's really interesting seeing people's analysis of those companies. It's generally UK small caps. And even if 99% of them are of zero interest to me, just seeing people's methodology and assessing a share, whether to buy it or sell it, is really good. And for a free email, I just can't fault it at all. I spend quite a lot of time on YouTube for investing stuff. There's a guy whose channel is called Pension Craft. I can't remember his actual name, but I think I'm right in saying he was an ex-hedge fund manager. So he's a very, very astute chap. It's mostly macro stuff, but it's very, very good. So he'll look at a macro issue each week and then suggest some ETFs or funds or bonds that might work well based on what he's seeing. It's about 15, 20 minutes each week, just superbly produced, full of information. There's a chap called Ian Shadrack as well. He's got a very good YouTube channel. He does a lot of spreadsheets, which he does sell, but you can use his YouTube channel. He shows you how to use his spreadsheets, and he shows you the ideas that they're currently generating. So I do use that quite a lot. One that I really like is Financial Wisdom on YouTube. They're kind of these weird cartoons, but all about investing. So he looks at different famous investors or fund managers or hedge managers or traders or whatever, and just does a 10-15 minute section on their techniques and how you can use them. So he did a really, really good video. I'll put it on my Twitter about using 200-day moving averages, and just explains in this really easy to understand way. So I rate that very, very highly. It's a really good channel. Lots of old investing techniques way back from the 60s and 70s he goes through and analyzes whether they're still effective today. The fourth one I use quite a lot is Economics Explained. It's more about economics in overseas countries. They just do really good articles. They are a little bit clickbaity, but there's a lot of good content on it. It's done by an economics professor in Australia who'll look at like the Mexican market and explain what's going on there. And it's very easy viewing, but really, really well done. There's been quite a lot of podcasts I listen to regularly. Obviously, your own one I've been listening to for probably 3 years or so now, I think. The other ones I regularly listen to, Fund Your Retirement or Private Investors Podcast. It kind of goes by two names. That's very, very good. That's the Maynard Payton one. Mark Simpson's also on there and a few other people. Morgan Housel now has his own podcast. So if you haven't read the book, I highly recommend that. Just 10-15 minute episodes covering some of the themes from his book. Conker's Corner, or the Twin Peaks investing podcast. That one's quite good. It can be a little bit long-winded. It's more chatting about the markets than it is looking at specific companies, but I find it quite good for generating ideas. They touch on a lot of companies I've never heard of. So that's been going for quite a while now and it's very good. There's one called the Small Caps Podcast with Paul Scott. So Paul writes the Small Cap Value Report, I think it's called, on Stockopedia each week. And the podcast is basically him going through all the shares he's analysed in the previous week and explaining what he's seen and what he likes and what he doesn't like. So it's really good if you're not a Stockopedia subscriber, you can still get that podcast for free and get a huge amount of the Stockopedia content free of charge. Merrin Talks Money, which is Merrin Somerset Webb, who used to edit Money Week. Her podcast, brilliant. BNP Paribas Wealth Management Podcast, again, very good. And I've touched on the Investors Chronicle one as well. That's a very, very good podcast indeed.
When did you start listening to us then? Because you must have been one of our earliest. Because we're basically, I think our 3-year anniversary is in September. So if you've been listening about 3 years, then you must have been a very early one.
Yeah. I'm just looking through my Spotify now to see what the first episode was of yours that I listened to. But yeah, it's been a while I've been listening to you guys. I can't remember the first companies I heard you covering or even how I came across you. But I do like the fact you cover such a volume of shares. There's a lot of investing podcasts, there's a lot of chatter, or they're very in-depth and there'll be 45 minutes on the same company. But I find the Investor Way really good just because you rattle through the shares quite quickly. And it brings out a lot of ideas that, like, for companies I haven't really thought of before. But I reckon it's probably at least 2, if not 3 years ago. It must be fairly near the beginning then.
Are there any watch list shares you've got from it then, just out of interest? Like any unusual shares you hadn't ever looked at
There's
before?
probably a few that you raised that I've actually not just watch listed, but actually gone on to buy. Associated British Foods, so we'll probably come on to that one later. But I don't think that was even on my radar until you mentioned that maybe a year, 18 months ago. So that went on the watch list fairly quickly. What else? Disney. I've only got a very, very small position in Disney. Again, I don't really invest in US companies. I don't really know why, but Disney went on the list and it pulled back quite a lot. And I thought, it's one of those companies that's got a history going back over a century. I'd like to bet it will still be around in a century's time. So it just seemed like a good time to get a little starter position. I tend to use the starter position as just a way of encouraging myself to do a little bit more research on a company. So just maybe doing an hour or two of research, open a starter position. But then when the RNSs come out, when the annual reports come out, it motivates me a bit more to dive into them and read up a bit more on the company.
When did you buy ABF then? Was it before or after that you had a look at the American growth?
Yeah, it was before that. I could tell you the exact date. It would have probably been about 18 months ago, I would guess. For various reasons. I don't know if you want to touch on ABF now or leave it later.
Yeah, no, it's fine, yeah.
So I bought that January 23. So, that was a reinvestment. I bought my first position December 21. So I've held that, 18 months or so now. I think that was around the time that, retail was starting to reopen a little bit. And ABF just looked quite unloved at that point, really. It was on quite a decent PE. I can't remember the exact amount, but it had fairly good news flow. We've got a Primark just around the corner from us in London. And I went in and it was really busy. So, yeah, I bought some shares. I've actually topped up again this week on ABF. It just has a lot of stuff going for it. So it's quite defensive. I think even if interest rates keep going up and people's disposable income keeps dropping, people will always be going into Primark and buying stuff because it's pretty much the cheapest place you can buy clothing in the high street by quite a decent margin. But also when you go in there, it's not actually awful quality. It's actually half decent, the stuff in there. I'm definitely not in their target market. I'm a bit old for that. But when you go in there, I'm quite impressed by some of the stuff they've got. And I've got a little 3-year-old. She loves their clothing. And for like new parents, you go in there and their stuff is like a quarter of the price of any other retailer. So I think it's quite recession-proof, for want of a better word. It's also quite diversified. So ABF as a company is a vast, vast company, and Primark is a relatively small position. I think people assume Primark is the bulk of their income, but it's not. They own a huge number of food producers, hence the name. Quite diversified across sugar, across, like cooking sauces and stuff like that. They also do a lot of animal feed, so it's really well diversified. I also think at the minute when food price inflation, according to ONS, is kind of 18, 19, 20%, that's got to have some positive effects on a company like ABF if they can manage those increases well long term. They're expanding into the US. I had a look at it again this week. They've opened a few more stores there since I did that Twitter thread. Just as a benchmark, I looked at H&M, which I guess is one of their closer comparators out there. H&M currently have 4,500 stores globally, and Primark have 400. I appreciate the footprint of the average Primark is probably 4 or 5 times the size of an H&M, so there's never going to be the same number because you just can't support a Primark in some smaller towns that can support an H&M. But even if you could say a quarter the number of Primarks there are H&Ms, that's still doubling the number of stores. They're opening like wildfire in Eastern Europe. The American stores, when you go on Google reviews, are getting fantastic reviews. They're opening more and more in new geographical areas, new states opening all the time. They've got a click and collect service, which if you look at the reviews of that, they get very, very good reviews. I think it's got a huge runway to potentially, I know they're not interested in it, potentially sell online, and click and collect a good stepping stone into that. It's a family-run company, so the Western Family Trust have 55% of the ABF shares, which is both a positive and a negative, but they seem to have had an interest in it for a long, long, long time. They seem to be running it very well. And then if you look at the PE, I think at the minute it's sat around 15 versus a 10-year average of about 21. I just look at the steps that they're taking, and I think all the steps they're taking are very positive. So in my mind, it should be above the 10-year average PE, really, whereas it's a sat position, like 3/4 of the 10-year PE. So I'm quite keen on Primark, you might be able to tell. Oh, sorry, ABF, I should say.
Yeah, no, we like it. We've covered it. Well, we cover it whenever the results come out. I think we did it again fairly recently, but we always have pretty positive things to say about it because it's just a very, very well run business. I think John's
exactly
very close to buying shares in it now. It's on my watch list. I just don't want any more retail exposure, even though obviously ABF is clearly a better company than Boohoo. But yeah, it's scarred me a bit. So who do you look up to as an investor?
I'm going to say the obvious one. Initially, Warren Buffett. I won't go into any more depth other than say if people haven't seen the movie Becoming Warren Buffett, someone has very kindly uploaded it to YouTube. It's a superb movie. It's more about Warren Buffett as an individual and as a philanthropist rather than as an investor. I went into it thinking it'd be more about his investment techniques, but it's a superb movie, obviously covering his upbringing, his marriage, his divorce, the death of his ex-wife, and that was really a catalyst for him getting more into trying to give away some of his money, really. He's an incredible human being, and if you don't believe that, you should go and watch the movie because it's fantastic. Peter Higgins, who's one of the Twin Peaks presenters, he's a superb investor, very, very, very astute guy, does it full time. I think he's just hit 50 or 60 of his shares now that have been takeover targets. Very, very successful investor, but also does a lot of work for charity, encourage a lot of positive behavior in the investing community if you follow him on Twitter or listen to any of his podcasts. And then I've just touched on him before as well, actually, Mark Simpson, who just started thankfully doing a lot of podcasts and a lot more work on Stockopedia. If you haven't come across Mark, I highly recommend checking him out. I don't know how he'd term his investing approach. I'd say value or even deep value or special situations, but just a very, very sharp guy, very switched on and very, very good with sharing his ideas and sharing his time and sharing his thought process on investments. So yeah, I highly recommend Mark Simpson if you haven't come across his stuff.
Which Twitter accounts would you recommend following the most?
Yeah, there's a few. I don't use Twitter maybe as much as I should. I'm certainly not very active on Twitter at all, other than doing a little bit of analysis here and there on companies that I personally hold, which I always think is a bit awkward if you're only commenting on companies that you hold. It can just look like you're ramping them, which I'm desperately not trying to do at all. So I'm not very active on there, but I do follow quite a lot of people. Expecting Value, Lewis Robinson's account. I think he runs a family office or similar, but he's very good. He shares a lot of advice on there. Temple 79 is Templeton Peck, I think his name is. Again, very good. There's a lot of analysis of shares. I find some people on Twitter share a huge volume of information. It can become a bit overwhelming, but all the people on this list, it's a manageable amount of content that they're putting out. There's a guy, I have no idea what his real name is, Rhomboid1MF. He's very, very good each morning. He publishes quite a lot of RNSs, both of companies he holds and other people's, just with his thought process, very switched on chap. Similar to that, the guy James1N1, who goes through the RNS each morning and just gives his views on a few companies, which is very helpful. Mark is on there. He's Danger Capital. Doesn't post a huge amount, but worth to follow just for some ideas. And then Leo Investor UK, who I think is one of the guys that runs Small Caps Live with Mark. Again, very switched on guy who's very good at sharing stuff on Twitter.
How have you evolved as an investor?
Yeah, it's a good question, that. I think it's quite a difficult one to really analyze and answer accurately. I feel like a lot of pursuits that people have in life, like I'm very into my long distance running, or you might be into your football. If you're rubbish at it, you'll have a circle of friends who'll tell you you're rubbish, and these are the reasons. Investing generally tends to be quite a solitary pursuit, and you certainly probably wouldn't share your entire portfolio even with people you know fairly well. So it's quite difficult to get impartial advice, which I think is a bit of a hindrance, really. So I've been trying to be more self-critical. I think one thing I've become a lot better at is being more patient. I remember when I started investing, I'd read a tip and I'd think, this is the best company I've ever heard of, and I'd be lying in bed at 9 a.m. and by 9:05 I'd have bought it. And I'm not talking big sums of money by any stretch of the imagination, but that fear of missing out is very, very real in investing. And I touched on it before, but seeing share price jump 10%, I wouldn't add it to my watch list if a tip came out and it jumped 10%. I think, well, I can't afford that now. So trying to realize that you haven't missed an opportunity as such. You can just wait either for a pullback or wait until you're a bit more comfortable with the share and that it's growing into its valuation maybe. I think as well as I've grown my portfolio, I've tried to build in more downside protection. I had a lot of fairly speculative companies early on that had a reasonable amount of debt and not many assets and a business model that could vanish tomorrow and you wouldn't really miss it. So I've been trying to build positions in companies like Disney where I can see a long pathway ahead of them. So in terms of downside protection, some of the things I specifically look at is shares with good asset backing. So one I've got quite a big position, it's probably top 5 for me, is Virtue Motors, VTU. So they're valued, their market cap is £240 million, but the valuation of their property, they've got a lot of freehold car dealerships. So their property, plant and equipment on their balance sheet is valued at £328 million. You're buying 300 million pounds of assets for 240 million pounds. And then on top of that, they're a very profitable company. They're on a PE of 6.9 and their earnings per share are growing at 8% a year. So I really look for opportunities like that where, even if the worst would happen and Virtue vanished tomorrow, there's £250 million worth of assets sat there that could be distributed to shareholders potentially. And also it just puts a bit of a floor in the price, I think. Virtue, I'm really surprised at 2 other motor companies that have had takeover bids this year. I'm really surprised that Virtue, in the position it's in, trading well, making acquisitions, really, really good leadership team, has not had a takeover approach just because it's so well capitalized. It's such a brilliant company.
Why do you think it's so cheap then?
I don't know. I think during COVID, when there was a big shortage of microchips and manufacturers were struggling to keep their production lines going. I heard anecdotally that Tesla, in the very early days of the pandemic, had people flying into China on tourist visas, bringing back a suitcase full of microchips because they couldn't get them out quickly enough. I think at that point, the supply-demand imbalance was so great. And then you had lots of people receiving furlough money and saving money on commuting out and buying cars, that there were retailers offering 0 discounts. It was list price or you didn't get the car. So Virtue had a really good time during COVID off the back of that. And I feel like they've kind of plateaued. They've just kind of traded in this sideways range a bit ever since. I'm not too sure what the reason is for that. Pendragon had a takeover bid a couple of weeks ago, and there was another company, I forget the name of, about 6 months ago. Again, a motor dealer had a takeover bid. So there's definitely some very shrewd people out there looking at these companies and seeing opportunities. I honestly couldn't tell you why Virtue is still out there, but very happy to hold it. Got a reasonable dividend and it's doing quite well.
I'd imagine it's quite a cyclical business though. So that partly could be why. Because a lot of the time when I look at something, it's like really cheap PE and it's like, what's wrong with it? My first thought now is always, it's got to be a cyclical.
Yeah, there's definitely a degree of that. They do have, not in any great number, they've got a couple of Ferrari dealerships and a few BMW motorcycle dealerships. You know, that's super discretionary spending. People aren't going to be going out and buying Ferraris. The economy's in tatters and people are worried. You know, it's a bit of a myth that the people that buy Ferraris are multimillionaires. A lot of people that go out and buy Ferraris are not that wealthy. They're quite often on finance. And a lot of people own them for a year or two and realize they can't afford to run them. So they are quite a discretionary purchase still. They're not the luxury bellwether that people maybe think they are. But then just the counter argument to that, Virtue also have divisions of the business that buy white vans to delivery companies and the like. You'd hope that'd be relatively recession proof. And actually one of their highest margin divisions is parts and servicing and maintenance. So they do quite well on that. I couldn't tell you offhand what percentage of their profits come from that, but you think even in a recession, people are probably going to carry on maintaining their cars. They're certainly going to carry on MOTing them. So I think it does have a certain amount of resilience. Definitely the profits to get hit, but I don't think it's a be all and end all type situation.
So yeah, I do think it was interesting what you said about if it goes up 10%, you wouldn't put it on your watch list. Because one thing I used to do was really just, I don't even know why I did it, but if I got to a point where I'd made a decision to buy a stock, the next day when the markets opened and I went to buy it, if it opened up, I wouldn't buy it. Because I'd be like, well, I don't want to pay more than I could have got it for yesterday when I decided. And obviously that's stupid because most of them, you're talking like 2%. You'd have paid that in fees anyway. But I used to be really bad for buying it. If it was up 2 or 3% after I decided to buy it, I just couldn't buy it. I wanted it on a red day.
Yeah, it's weird, isn't it? I don't know where that comes from. I definitely say in all other areas of my life, I'm extremely tight with my spending. I will not spend money if I don't have to. You know, I look for deals on everything. When I go traveling, I'm looking for the best offers on hotels. Even if it saves me literally £5, I'll spend an hour trying to find that £5 saving. And I think that certainly comes from my upbringing to a certain degree. And it's a really hard thing to shake off. I think the Morgan Housel book is very, very good for that because, you know, in the UK society, spending money on flashy objects is very frowned upon, and it's not really the done thing in most parts of the UK, I don't think. Having spent a lot of time in the US over the years, I lived there for a little while, their ability to display wealth is just incredible. And then you go to the Middle East and that's like turbocharged really. So it's definitely something I'm trying to work on better. And also if your share's going up in value, that's a good thing. You want to be on that share. You know, if it drops by 10%, you're not getting a bargain. You're buying it because something bad's happened to it. So it does take a lot of time to rewire those practices, definitely.
But do you have anyone that you know now in real life that you chat to about investing, or is it still a mainly solitary activity for you?
Yeah, it's mainly solitary, if I'm honest. Quite a lot of my workmates manage their pensions. A lot of pilots had careers before flying. In fact, virtually every pilot had a career before they got into aviation. So I do work with a lot of guys who used to be accountants, a few hedge fund managers. Quite a lot of people who used to work in IT, so have specialist knowledge in that field. Quite a lot of people in my industry manage their own pensions. So we do chat at work about what we're investing in and stuff like that. When you're sat reading Shares magazine, people ask you questions about what you've been doing with it, but not really anyone in particular I chat to. My dad, every now and then, he still trades in shares, but no one particularly.
Okay. What are your thoughts on current valuations in the US?
Yeah, it's a really interesting and difficult question to answer. I think the obvious response to that one is if you strip out the 6 or 7 FANG stocks and Nvidia and everyone else, the US market isn't crazy overvalued, but that's a very obvious, simplistic response to it. When I look at Nvidia, price earnings of over 200 now, you know, even if it grows at 50% a year for the next 3 years, it's still on a PE of at least quadruple what I would pay for any share. And that's assuming it gets 50% growth every year for 3 years compounded. Particularly if you look at Nvidia, their earnings per share last year fell, and this year, year on year, they're only up 28%. So they're doing very well, there's no doubt about it, but they're not going gangbusters, and paying 200 plus PE is just crazy. So I think it's quite easy to strip those companies out and then say, you know, the market as a whole is a little more highly valued in the UK. Did dig out some numbers actually. So the S&P at the minute is on a PE of 25 and the FTSE's on 11. If you look at the S&P, Their average going back to 1870 is 16. So you could easily argue they're on a 50-60% premium to their historical PE average, and quite a big fan of the idea of everything mean reverting at some point. So I definitely think at a point that's going to come back down again. But then there were plenty of people 5 years ago saying the same thing about Tesla, and they were hideously wrong. So who knows, really. I think one interesting thing when you look at sector comparisons between the US and the UK, you sometimes find it's not as crazily valued as you might have expected. So in Money Week, this last episode edition, they compared US pharma and biotech shares. So in the US, they average a PE of 21, and in the UK, they average 15.5. So yeah, it's a 30% or so premium, but given the economic outlook in the UK versus what seems to be very good inflation numbers coming out of the US at the minute, I don't think a 30% premium over the UK is too bad, really. It's a little bit high, but it's not ridiculous. So when you look at individual shares, sometimes they don't look as bad as you might think in the US.
So if you think that, why don't you own that many US companies?
It's a good question. I find the research a bit more difficult for US companies. I am thinking about extending my Stockopedia subscription to cover US stuff as well, because a lot of my idea generation comes from the Stockopedia screens where I look for companies that meet certain criteria. So I might extend that into the US to buy a few more. I find as well there's a lot of podcasts in the UK that cover quite a wide range of UK companies, from mining. I've got a few mining companies, not specifically mining, but they'll touch on mining companies. They'll cover UK tech, they'll cover UK pharma, they'll cover a lot of different subjects. Whenever I seem to tune into the US ones, they seem very tech focused. I do have some tech holdings, mostly via funds like Polar Capital Technology. I'm not massive on my technology. I think it's quite expensive, and as we've touched on before, it's something that I struggle with quite a lot. So I will have a look at it at some point and try and find some value options in the US, particularly as the exchange rate seems to be normalizing a little bit better now than it maybe was in the last year or two.
What do you think of current valuations in the UK?
I think 11.1 isn't a bad PE for the FTSE 100. I do think there's still a lot of uncertainty at the market. Interest rates for retail borrowers on mortgages over 6% now, and probably going up by another 0.5% with the next base rate review. That's a big number. That certainly hasn't played out in the market yet. So that's a bit of a concern for me. I think, we went to the pub yesterday for lunch, and as we got out of the car, they said, sorry, we're closed because we can't find any staff. There's a restaurant around the corner in Kingston's just completely closed down because they can't find the staff. There's a lot of things, as partly as a result of Brexit, maybe partly just cost of living problems that really haven't played out yet. And with inflation seeming quite sticky at around 8 or 9%, that concerns me a little bit. And maybe a PE of 11.1 isn't too harsh with all that uncertainty at the market. That being said, I do still see quite a lot of value in a lot of assets. I've touched on REITs before. There's a lot of REITs that are down 50% on their net asset value. That, to me, seems like quite an overreaction on those. I can't see a situation where commercial property is going to drop by 50%. I'm quite happy to pick up REITs at a 50% discount and earn a 6, 7, 8% dividend yield while I wait for them to re-rate. So I see pockets of value. I think as a whole, the market 11.1, that sounds about right to me, really.
How do you think about allocation and position sizing?
Yeah, so we touched on it a little bit before. So I have quite a lot of my holdings are in ETFs and low cost trackers. So there's 3 that I predominantly use. One is an iShares All World ETF. I've then got an iShares Smaller Companies ETF, and I've also got an Emerging Markets one. So my reason for that is try and distribute my investments a little bit better. If you buy an All World ETF, it's hugely exposed to the US still. And I see a lot more growth at the minute, likely to be coming out of India, China, Vietnam, places like that, than I do in the US over the next 10 or 20 years. So within my portfolio generally, my ETFs sit around 45, maybe 50%, just depending on what I've got. And I also use those as a bit of a cash alternative. So I buy a small sum of ETFs every single month. And if I want to start a new position in shares, I don't have the attachment to an ETF that I do to an equity. I find it quite easy just to sell a couple of percent of an ETF to buy a new equity position. So it's just sat there, earning just a smaller bit of money on the sidelines, but without the commitment, for want of a better word. And then within my remaining 50%, it's roughly split half between some funds and half into equities. And I try and keep about 5 or 6% cash, just so I can take up any opportunities as I start to see them. Generally, I'll start a position at about, I said before, 0.5% to 1%, something of that order. Once I get a bit more conviction, I might increase up to 3%. And when they become high conviction, maybe 6 or 7%. Once they get any larger now, I tend to top slice them a little bit. Touched on Next 15 that I bought back in 2006. That is almost 30 bags since I bought it. So that one, even though I put a very small amount of money into it, becoming just such a huge part of my portfolio, I just had to top slice it a couple of times. So I've sold off a fair bit of that now, and the bit I still hold has been more than covered by the gains. So I kind of see that as free money. So I've committed never to sell that bit. Actually, I'm thinking about increasing it again potentially. I have had a bit of a bad habit of averaging down on companies, which again, the 200-day moving average really helps me avoid doing that, or at least time it better if I do that. Touching it before averaging up, I think, is a fantastic technique. As you get more knowledge in a company, you get more comfortable with how they're performing, and you can see them when you're walking down the high street, like with Primark every day, and you see hundreds of people milling around in there. It gives me the confidence to go in and increase those positions in a way that I could never have done on day one of buying.
How much time do you spend a month on investing in your portfolio?
At the minute, I'm not opening many new positions. So I think in the last 6 months, probably even 3 or 4 starter positions maybe. So I'm not putting a huge amount of work into researching new companies. I'd say actively managing our portfolios, maybe 4 or 5 hours a month. I normally take a half day before the regular investments go through and look at what they're likely to going in, look at the trends and see where I think they'd be best placed. It takes me a couple of hours. I go through my watch list normally once a month. Again, just look at the chart, seeing how shares are performing, seeing if there's any news. I'd say about maybe a half day a month on doing that. I spend a bit more time reading blogs and RNSs, probably about 10 hours a month trying to do that. I think it's almost like compounding your knowledge. Once you start following a few companies and you start reading the RNSs and then you start noticing the companies out in the wild, you start picking up that information much more quickly. So it doesn't really take me that long just to flick through the RNSs in the morning, maybe half an hour or so. But over 2, 3, 4 years of investing, that does build up quite a good knowledge of companies that are out there that are of interest to you. And then podcasts, I always have a podcast on in the car. So I spend probably about 15, 20 hours a month listening to various different podcasts. I think that and YouTube are probably my preferred source of new ideas and just general discussion on macro.
What are your thoughts on Bitcoin as an investment?
Yeah, I think we chatted about this a little bit at the Fundsmith event. I'm not anti-Bitcoin. It's just not really for me. I think there's 2 reasons for that. Like, there's kind of 2 ideas I have of how Bitcoin could end up being the next big thing. One, it just becomes a trading tool, but it's very, very popular, in which case it definitely isn't for me because there's plenty of metals and futures markets that you can trade, which are plenty volatile enough for me. Or it gets adopted as a de facto currency somewhere like some of the South American countries are doing. But to do that, it needs to be a lot less volatile, which is one of its only appeals. So a lot of those people that trade it purely because it's volatile will then be forced out of the market a little bit. I think it's just popped up past 30,000 US at the minute, whereas at its peak it was at 64. And I think 64 is a crazy valuation for it, really. So even if it returned to that tomorrow, which I don't think it will, I'm still only doubling my money. And if I think about how much of my portfolio I'd be willing to hold in it, like if I was really feeling like a gamble, maybe 5%. So at best, my best case scenario, my return's going to be 5%. It's not enough to make that risk worthwhile for me. So even though I'm not anti-Bitcoin, I struggle to see how it would fit in when I'm long-term investing for pensions. I'd far rather have a boring company compounding at 6, 7, 8% all day long than I would something like Bitcoin, where you've got to pay a bit more attention to it, and there is a lot of risk associated with it in my mind.
Right. Well, that brings us to the end of the first part of this interview. Firstly, thank you very much for coming on the show.
No worries at all.
Where can people find you if they want to find more about you?
So I'm on Twitter as Flying Finance. I'm not very active on anywhere else, so that is probably the best place. You can DM me if there's any of the companies I've talked about that are of interest to you, or any of the techniques I've talked about. I'll try and share the video on the 200-day moving average that I mentioned there when this episode goes out. So yeah, it'll be there.
Okay. Well, thank you very much for listening, everyone, and we'll see you all next week.
Thank you for listening to The Investor Way. To get in touch, please follow us on Twitter at TIW Tweets. This podcast is for entertainment purposes only and does not constitute financial advice. Neither Sam nor Jonathan are financial advisors. For investment advice, please consult professional advisors.